All right, all right. I know I'm a little late to the party here, so please don't give me too much grief. Cut me some slack. My wife and I just had a baby and we have been enjoying it. But I wanted to make some time to jump into this conversation about the Fed and monetary policy because it's so interesting right now. The markets are going crazy, and I just wanted to kind of spell out some of the thoughts that I have about all this situation going on. As you guys know, the Fed had its meeting this week earlier on Monday, and on Wednesday, Jay Powell gave us some, not much, but some insight of how determined and aggressive the Fed is going to be in tightening the monetary policy this year. And so today, I just wanted to comment on some remarks made by Jerome Powell and kind of spell out a little bit of what it means for us as investors, obviously with the limitations of my knowledge. Hi there, my name is Hector. If you're new around the channel, here we talk about everything related to personal finance, from real estate, stock market, cryptocurrencies, NFTs, you name it. If you're a sucker for those kind of things, please consider subscribing and help me to get to that coveted 1 million subscribers. Hey, also hit that bell notification so you keep up with all the videos that I post. All right, without further ado, let's play a short clip from the opening statement at the press release. By the way, if you already watched this, please feel free to jump ahead. It's just a couple minutes, but I do understand if you want to jump and not lose your time if you already watched it. But for all of you guys who haven't watched it yet, I just want you to hear it straight from the horse's mouth. Pay attention to what Jay Powell has to say here.
The Fed's monetary policy actions have been guided by our mandate to promote maximum employment and stable prices for the American people. As I noted, the committee left the target range for the federal funds rate unchanged and reaffirmed our plan, announced in December, to end asset purchases in early March. In light of the remarkable progress we've seen in the labor market and inflation that is well above our 2% longer run goal, the economy no longer needs sustained high levels of monetary policy support. That is why we are phasing out our asset purchases and why we expect it will soon be appropriate to raise the target range for the federal funds rate. Of course, the economic outlook remains highly uncertain. Making appropriate monetary policy in this environment requires humility, recognizing that the economy evolves in unexpected ways. We'll need to be nimble so that we can respond to the full range of plausible outcomes. With this in mind, we will remain attentive to risks, including the risk that high inflation is more persistent than expected, and are prepared to respond as appropriate to achieve our goals.
In all honesty, throughout the press release, his responses were rather ambiguous in terms of indicating exactly how aggressive the tightening is going to be this year. But judging by the rather hawkish tone that he had, one thing is for sure, and that is that this year the Fed is focusing on reducing inflation. So rate hikes are going to come. When and how many? Well, that is exactly what we need to talk about because that's what the markets are trying to figure out and price in right now. All that to say though, this is the perfect setup for a very, very volatile market. So whatever you are in, stock market, real estate, crypto, if you own any kind of investment, you have to pay close attention to the Fed's monetary policy this year. I understand it's hard, but it is very important because this year particularly we're playing macros. So whatever the Fed does is going to affect your investment. And as Papa Powell said, and we have mentioned in this channel over and over again, the Fed's dual mandate is to achieve maximum employment and price stability, aka regulate inflation. So unemployment levels right now are looking very strong. So the natural move for the Fed right now for this year is to try to tackle inflation. All right, but what about timing? When can we expect those rate increases? Or what about the balance sheet reduction? I would say that we're expecting the first rate increase in early March, and this would perfectly line up with the Fed's meeting scheduled that month. Just to clarify though, this was not specifically said by Jerome Powell, but it's what everybody's speculating based on the timeline given by the Fed back in December regarding asset purchases. So the logical conclusion is that the Fed will begin with the first rate increase at the same time that they will stop the QE, or quantitative easing. Another thing is that his responses don't necessarily give a hint on how many rate increases there will be, which is expected since he knows that that could cause major market moves in either direction. Rather, he says that the Fed will remain nimble to adjust to market situations. This is convenient for the Fed so they can remain flexible in case they need to adjust and move or pivot on the fly. So what that tells me is that not just the pace of the balance sheet reduction is on the table to be adjusted based on the market circumstances, but even the number of rate increases might as well remain to be determined. This is important because the market sentiment right now is already pricing in at least 4 interest rate increases. If you take a look at the charts right now, there's a lot of sideways movement right now. It looks a little choppy, really, but if you look at early January, you can see how bad that sell-off was right after the minutes from the Fed's meeting back in early January was released. All the big indices went down substantially. I believe this happened because markets worked on expectations, and so after the minutes were released, markets actually confirmed what was said back in December, and so they started to price in all those rate increases. So the next remark, I thought it was important for us. I'm gonna play a clip right now and then I'm gonna comment on it. But the question that was asked to Jerome Powell was, can the Fed bring inflation down without hurting unemployment levels? Let's watch this clip.
So the thing about the labor market right now is that there are many millions of more job openings than there are unemployed people. So you ask whether we can raise rates and move to less accommodative and even tight financial conditions without hurting the labor market. I think there's quite a bit of room to raise interest rates without threatening the labor market.
Okay, this is, I think, a very important question, and I'll tell you why. Again, the Fed's dual mandate is to keep maximum employment and inflation under control. Right now, in the eyes of the Fed, and statistically proven actually, if we see that, look at the graphic, unemployment levels right now are very low. So we are in a very strong labor market. This means that there are more job openings than unemployed people. Not just that, but the earning reports are coming in incredibly strong and even beating expectations, with companies like Apple reporting their largest single quarter in terms of revenue ever, with an all-time revenue recorded of $123.9 billion. That is an increase of 11% in a year-to-year revenue despite supply challenges. Tesla reported earnings of $2.52 per share versus $2.36 per share expected, and a revenue of $17.72 billion versus a $16.57 billion expected. All this reassures the Fed that the economy is indeed strong right now and it can tolerate a pivot in monetary policy. So in the eyes of the Fed, and I quote, they can move rates up without undermining the labor market. This basically gives the Fed green light to endure certain levels of market volatility without being concerned that we're going to enter into a recession or worse than that, a season of stagnation. So in other words, these are good news for the average American who will see the prices of goods and services averaging down in the next few months. But it's probably bad news for investors because the Fed now can potentially be more aggressive with policy tightening. I have to point out though, I don't believe the Fed will opt for a more aggressive policy tightening strategy unless they really need it. But as he mentioned, there are other factors at play affecting inflation right now, i.e., supply chain issues and fiscal policy. And I think these two are going to play a big role in 2022. So what does that mean for us investors? Well, that means that we'll have to keep an eye open on supply chain issues like semiconductors, workers, shipment container traffic, etc. Something that we need to keep in mind is that what we're experiencing right now in the economy is an unbalance caused first and foremost by a non-sustainable financial system model, but also many times amplified by the effects of the pandemic. So the hope is that as monetary policy tightens up and supply chain issues resolve, we should be able to see the economy rebalancing on its own and hopefully coming back to normal ranges of inflation without aggressive measurements by the Fed. The only problem I see though is that I can't yet figure out how they're going to make workers go back to work. You see, one of the main issues that caused the supply chain problem is the lack of workers. In 2020, many people were laid off because of pandemic-related issues. Some other people decided to retire during that time, and many other people decided to quit their jobs because of pandemic concerns as well. Several reasons were at play during that time, but the problem is that many of those people aren't back yet to work. No longer because pandemic concerns, but simply because they don't want to work. Or for some other people, it doesn't really make sense, financial sense, to go back to work because they might be getting more money just sitting in their houses, getting some financial assistance from the government. And so I think this is where fiscal policy will play a big and very important role in bringing those inflation levels down. Remember those stimulus checks? All right, so this is how I think things might eventually play out, hopefully. So the Fed first will start moving interest rates up. This will potentially discourage spending in the economy, bringing prices slightly down. At the same time, fiscal policy should become less accommodative, which means that the government will cut the stimulus and other pandemic-related financial assistance. As a result, people's savings will begin to decrease, and so people will have to get out and find a job. This should relieve the current worker shortage, which should help with the supply chain shock, which should greatly contribute to bring prices even lower. I know all these things are speculative and there's not really a defined time frame in which all these things are going to happen, if they do happen at all, but all we can do for now as investors is to keep an eye on all these factors and see how they fall in place. Remember, if inflation begins to move down without much intervention of the Fed, they won't have to apply any aggressive monetary policy. In fact, I would argue that the Fed's preferred choice is to not interfere at all in the economy rebalancing, or at least to not be the main force behind its movement. Why? Well, as I said in the video published a few days ago, which I would recommend you to watch if you want to know more about the Fed and how it works, if the Fed intervenes too aggressively in the economy, it could tank the market, sending the entire economy into a recession. This could backfire, bringing unemployment levels back up and slowing down the growth of the economy. This begs the question, is there still any scenario in which the Fed bails out the stock market in reverse or reduce their approach in interest rates increase? To that, I would say, yes, it's still on the table, but I would not bet my money on it. And this is why.
As you know, the ultimate focus that we have is on the real economy, maximum employment and price stability, and financial conditions matter to the extent that they have implications for achieving the dual mandate. And you also know that we look at broader financial conditions, not one or two things, one or two markets. And what we're always asking ourselves is, are we seeing changes that are both persistent and material enough that of a change in financial conditions that they are inconsistent with the achievement of our goals? So that's how we're looking at that. And I don't want to comment on today's financial conditions broadly, but we're not looking at any one market or so. So that's how we're thinking.
Yes, well, the state of the stock market is in the Fed's radar. It doesn't seem to me that Jay Powell is too concerned about it. What I mean is that it seems to me that the Fed is rather comfortable dealing with some volatility as a collateral damage. So please be very careful if you're in this market right now. So for now, if you guys appreciate this content, would you do me a big favor and gently tap that like button for the YouTube algorithm? It helps a lot, they say. Also, subscribe to the channel and hit that bell notification so you get notified every time I upload a new video. Well, I hope you guys enjoyed it. Bye.